I'm not sure if the board is visible. It's not a very serious board, but I want to just assume that you can see something small. Yes. Let us just use this. Tutavumilia tu kidogo. So we are continuing with our syllabus. We are at topic 5 out of 10. Out of those 10, moja tushafanya ya mwisho inaitwa reporting. We'll only go through it during when we get time for revision. We'll go through it. Otherwise, we are in topic 5, meaning that after 5 we'll remain with 4 serious topics. Then we start blocks. That is how serious we are. And paper as usual. As usual, we'll be looking at past paper. So the topic is audit, evaluation, and review. So this topic comes immediately after topic number 4. Topic number 4 was talking about audit practice and management, or management of audit practice. Management of audit practice. So under management of audit practice, we are able to look at the whole audit process from the start to the end. From the time you have applied for tenders to the end, right? Reporting. So that was the normal audit practice. Now, once you've done the audit, you are done with the audit that you are managing under topic 4. You've done everything and you are back now to the office. You are actually having the evidence that you need. You need now to start looking at those evidence so that you can make judgment. You need to evaluate them and make judgment. You need to evaluate them and make judgment. Thank you very much. Somebody is commenting here. A friend of mine is commenting here, anasema that as long as the audio is clear, we are good. With a suggestion, lunch hour is a busy, lunch hour of Kenya is a busy working hour of Rwanda. I'm suggesting classes for 8 p.m. Kenya's time is much favorable to many working class people. Thank you. Okay, so that's fine. I like that comment. So that means that we'll just proceed like this. Then you can always call me in case you meet any challenge for the previous classes once in a while. You can always call me. If you are in the paid group, you can always call me. So let's proceed. That once you've done an audit, you come back to your office at the desk. You need now to start looking at evaluation. Evaluation is basically means judgment. You now need to judge the kind of work that you've done. You look at it, review, and judge. So that is why we're talking about evaluation and review. So evaluation and review. You now look at it and make judgment out of it. The reason why you're doing this, you want to make sure that the work that you've done is actually of quality. It meets the target. It's a good report. The kind of audit work that you come up with. It's a good report. It meets some quality. So with that in mind, what are some of the things that you need to think about after you've done the audit work? What are some of the areas that you need to look at once you've left the field? During your review, what are some of the things that you need to check? So number 1, you need to look at the financial statement, assertions, and audit procedures. You need to look at the financial statement, assertions, and audit procedures. Financial statement, this pen is not very serious. Let me get a serious pen. This pen is misbehaving. So you need to look at the financial statement, assertions. Assertions and audit procedures. So why do we look at this? I'm just saying that you need to look at, I think that side is the automatic light. I'll be writing on this side. I'm saying that you need to look at financial statement, assertions, and audit procedures. Why do we look at that? Number 1, we know very well that when you've done an audit, there are things that were given to you or beliefs that you are given. Those beliefs were given to you. You've done audit procedures. You need to confirm. You need to confirm whether they really make sense, whether they are in line with the audit procedures that you have and the evidence. So what I'm saying, assertions are the beliefs or presentation that you are given by the client. For example, the client say that the transactions were accurate. He said that they were complete. Those are assertions. We call it ACCA cover. These are assertions. ACCA cover. These are assertions. So when financial statements are presented to you, there are assumptions that management believes that these financial statements are okay. And so they are accurate, they are complete, they are cut off, meaning that they are within the year or the period under audit. They are, another one, can somebody assist me with this? ACCA cover. Accuracy, completeness, cut off. Another person, I know I've taught you this. We also talk about valuation, value, existence, and then we have here ownership and obligation. No, occurrence. This one is occurrence, not ownership. This one is occurrence. This one is rights and obligations. Any suggestion? We have here, we still have here two items remaining, A and C. Those who are in my class, wakina Ruth, hiyo inamaanisha nini? Hebu nikumbushe. Just remind me, guys. So these are the assertions that sometimes you can be given. When you are given such assertions, it means that the client, when he gives you the financial statement, he says that they are accurate, they are complete, cut off, transactions occur, they are valid, they exist, and they have the rights and obligations. These two I will remember, I'll give you. Now, on top of that, now we are saying, once you've done transactions, you ask yourself during review and evaluation, you ask yourself, did you check the assertions? Which audit procedure did you follow to confirm the assertions? And that is why the first thing, financial statement assertions, these ones must have been checked, and you ask yourself, what was the audit procedure? You are now trying to evaluate. You are trying to review the work that you did. Was it making sense? That is number one. That is number one. Number two, subsequent event. Number two is called subsequent event. Number two is called subsequent event. So you ask yourself, what are some of the things that happened that have impact on the financial year? For example, subsequent events are those things that happened after the year end, but have impact on the financial year. Let's look at these ones. An example of subsequent event. An example is, that is number two, subsequent event. You ask yourself after audit, is there anything that happened this year that has impact in the last year's financial statement? Remember, at the end of the year, when the books were closed on 31st of December 2019, for example, and you are doing audit. So meaning that at the end of the year, we had, for example, debtors probably there were 30 million. 30 million were debtors as at the end of the year. But then what happened? After the year end, some things happened. Those things are what we call subsequent events. So they happened from January 2020 going forward. Anything that happened here that has impact on the previous year's financial statement is called subsequent event. So let's think about this. You close with debtors 30 million, but then in January, some of these debtors, you realize that they are not going to pay. One of the debtors died. Amekufa. He has died and the amount was not insured. So you cannot actually recover that money completely. We are together. The year has ended, you close with your books as part of receivable, you had debtors as a receivable of 30 million. The client who owed you this money got an accident after the year end, and he owed you probably 15 million. He got an accident, he died. That means that you are not going to recover this amount. It's no longer there. So meaning that when you are doing audit around March, he died in January, you are doing audit around March, what will happen? You cannot say that this 15 million should still remain as receivable. It is an event that happened after the year end. The death happened after the year end. It changed the status of the financial statements, meaning that it is no longer receivable. It is now part of bad debts. So that is what we are talking about, subsequent event. So when you're doing audit, during evaluation and review, you ask yourself, was there anything that occurred, any occurrence in the subsequent year, any occurrence after the year end that has impact on the financials of the previous year? That is what you need to review. You need to ask yourself, if there is any, then you ask yourself, how can we adjust that kind of occurrence? Let's take example. When this happens, then obviously, if you report the books, you end up during audit, you report it as part of receivable, then you are lying. It should have been adjusted so that we have part of it as bad debts. You are going to debit bad debts with 15 million. You credit debtors, reduce debtors by 15 million. So you credit debtors by 15 million. That is what you're supposed to do. So that at the end of the day, we report only 15 million as receivable, the rest bad debts. So, yeah, the other C is classification. This other one, A, hatujapata vizuri. It is not the right one. It's not arithmetic. I know you will get it, but classification, you got it right. Thank you very much. We still look for the rest. So let's come back here. So that is basically what is happening. So meaning that you have to check if those circumstances occur so that you can be able to adjust. Those are what we call subsequent events. They are events that happen after the year end, but they have impact on the financial year. So, okay. Now, subsequent events are two types. We have two types of subsequent events. There is one that is called adjusting event. Another one is called non-adjusting event. We have one that is called adjusting event. Then we have another one, non-adjusting event. Types of subsequent event. And in exam, they will ask you to define, and they can even give you some calculation. Then they ask you a case study. Tutaangalia, we're going to check on that. How do we handle such cases? So let's look at the types of subsequent event. The first type, yes, thank you very much. You got it now. Allocation, not accuracy. Accuracy are given. The next one was allocation. So we had allocation and classification, right? Then you can fill it on the gap where we left. You can fill those two. Allocation for A, then the other one is classification. Thank you very much. Those are now total assertions. Okay. So let's come back here. We are saying that subsequent event, there are two types. We are saying that these are things that happen after the end of year, after the year end. But now there's one that needs to be adjusted in the books, and then there's one that you don't need to adjust. You only need to explain or expose. That is called non-adjusting event. So you have those two, adjusting and non-adjusting events. Are we together? Adjusting and non-adjusting events. Now, in exam, they will ask you to first tell us whether it is an adjusting or non-adjusting. Which one is an adjusting event? Like the one that we just seen, where you have to adjust in the books because of something that happened. That is called adjusting events. They have to be adjusted in the financial statements. Non-adjusting is, for example, after the year end, a very senior official of the company has left. They don't have impact on the financials, but you just need to explain. So whoever wanted to invest, if investing because of the performance of last year, and that performance was good because of the CEO who was there, you now need to explain that the CEO is no longer there. Or if there was a possibility of strike, you need to disclose. Those are not adjusting events because they have no impact on the financials. They have nothing on the financials. So the ones that have something on the financials and that needs to be adjusted are the only ones that you can adjust. In this particular issue, that is what you need to look at. The next item, apart from this, I'm just highlighting because we're going to look at them deeply, and I know we are going to be with you. The next one, number 3, we are talking about going concern. You ask yourself, going concern, what does that mean? I normally tell my students that there is a time I was doing an audit, and so we were doing interview. We were interviewing new recruits. Then we asked one of them the meaning of going concern. Sasa, this person was telling us that this new recruit was telling us that you see, going concern, it means that the organization is going, but is concerned. They are worried. Yani, they are moving on, but they are worried. That means that going concern. So, as a good student who attended my class, you can never define going concern like that. Going concern is an assumption. It is an assumption that says that the company can still continue in operation, at least into a foreseeable future. It is an assumption that we use during presentation of financial statement. When you are presenting a financial statement after audit, it is assumed that the company is going to continue in a foreseeable future. And that assessment, going concern assessment, or trying to understand whether it is true, evaluate, that one should be done by the management. So the management should assess or perform what is called going concern assessment. Your work is only to come and check whether the assessment was correctly done. As an auditor, you only come and check whether the going concern assessment that was done by the management was correctly done. The assumptions that they made, how they reported it, were correctly done. That is what we mean by going concern. So going concern is the assumption that the company can still operate in a foreseeable future. Why is it important when you are giving report, when you are evaluating after the audit? It is very important because remember, the users of the financial statements want to depend on you as an auditor. They trust you very much and they want to depend on you that whatever you're giving them is okay. So because of that, what they are doing, they want you to comment on the future of the business. Should they invest today? What will happen tomorrow? Give them that surety. Tell them the truth that this company can still continue in operation. Go and put your money there. It is safe. So that is why, as an auditor, I can't give my report without mentioning or checking on the status of the company when it comes to the future. Because people will invest in that company because they depend on my report. And one of the things that I have to mention is that particular one. So going concern, I have to mention whether it is going to operate or not, according to my evaluation. Is it going to operate? So in this particular area, we have to look at factors that can actually show that the company cannot continue. What are some of the indicators that a company cannot continue as a going concern? What are the factors? An example of factors that you need to check that we'll look at later. If you realize that the company has management problems, people keep on leaving the company. Yeah, they employ, but after some few months, people leave. That shows that there is a problem in terms of management and the possibility that the company cannot continue operation. Number 2, they have liquidity problems. If you realize that the company has challenges in terms of money, they don't have enough liquid money, then you can know that they might even fail to pay their debts when due. All those liabilities when due, they cannot pay because they don't have money. The next one, when senior people who are quite professionals leaves the company. When they come, they're employed, they keep on leaving. Or even if they have been there for some times, but then they realize that the company has a problem, finance manager has left, FM auditor has left, CEO has left, so the company is remaining behind, being managed. The company being managed now by junior employees. Senior people have left. That is another indicator that the company has a challenge. It has a going concern problem. The next one, when you realize that the suppliers of the company, like creditors, they only want to be paid in cash. They don't allow credit sales. That shows that there is a problem. Because remember, the creditors understand the company. They understand the company better than you. So if they understand the company better than you and you're the auditor, if you see that they have changed their mind, they are now saying that, Mimi, if I supply you with everything or anything, you have to pay me cash. Tunamalizana. Yani, I'm paying you, I'm giving you product or whatever service that I'm giving you, you pay me right now, your story is shit. What does that mean? That shows that these people are also doubting the future of the company. They are feeling that the company might not exist tomorrow. So that is a sign that these people have a going concern issues. Another example that can show you or an indicator that a company has a challenge, it might not continue in operation into at least the next 12 months. At least into the next 12 months, it should still exist. The company might not exist. Another example is that they are failing to pay salaries. A company that does not pay salaries, people have like 6 months ago, their salaries for 6 months ago, 5 months ago have not been paid. There are two things, mismanagement or going concern. So, because some people also have money but they don't want to pay people, which is something to do with the HR issues. But then the main indicator is that such kind of things indicates that the company has challenges. They cannot pay salaries. What do you think from your experience can also cause a company have such kind of challenges? What are some of the indicators that a company has going concern challenges? Those are the things that will come in exam. Can somebody tell me what are some of the things that when you see, you start doubting on the ability of the company to operate at least for the next 12 months? Just type, or you can talk. I can unmute you. Then you talk. Yeah. Any? Large amount of debts, yes. Close of branches, that is true. Those are good indicators. Other indicators? Sorry, so I'm saying that for the new guys, we have a problem with the camera. Just in case you are seeing that, don't mind. We know that with your support and that of God, we'll be able to buy a clear camera very soon. You are going to support us. We are going to be able to have enough money to buy a camera. That is the only challenge. We have a studio with a board, but there's no clear camera. So that is the only challenge. And we know that you guys are going to subscribe to our classes. You're going to pay something small so that we can buy a camera. so that we continue the class without any hiccup. Okay, so I was talking about this related party transaction. We are saying that after the audit, when you are doing evaluation and review, you need to ask yourself whether there was any existence of related party transaction and how was it treated. An example of related party transaction is when you supply anything or you engage in any business with somebody that is your relative. An example is maybe your sister, your brother, former schoolmate, girlfriend, fiance. You are telling them to apply. You're going to do business. So what we are going to look at here, you ask yourself, how did the organization treat? How do they disclose or treat related party transaction? And that is something that you can ask in exam, how to treat related party transactions. So in exam, they can ask you like this, that you have a new auditor. This particular new auditor understand that there are some risks. He understands that there are some risks that are associated with related party transactions. Explain to him in a language that he can understand what you need to check when auditing related party transactions. That is a kind of a question that you can meet. So our issue here is to ask the management, how do they treat, what is the policy saying about related party transaction? There are some policies in organization which says that in case of any related party transaction, you need to disclose. The reason why, if I'm the CEO or I'm one of the board of directors, and I realize that maybe one of my friends have applied for a job, I need to disclose that I have interest here. The person that has applied is one of my friends or relatives. So when we are debating, when we are judging, or when we are evaluating his application, I should not be part of it. I should not be part of it when they are doing evaluation or trying to give out the tender, because I'm going to influence the process. So that is one of the ways you need to disclose. Number two, there are some risks that are associated with related party transactions. An example, apart from showing self-interest, most people, when they are related, even when you stay at home, you are very close to your husband or your girlfriend, you can always give them free money still. But if you don't write it down, because you know each other, you guys don't write down. If you don't write down, then something happens in the future, you will come and start blaming each other. That is the time you know the true color of each person, because nothing was written down. You are doing business out of trust. So when something happens, there is no evidence. That is when you tell somebody that, you know, I gave you 500,000 when you were doing this business. He will start saying that I don't even remember. So conflict will always be there and there is no evidence. So when related party transaction, ensure that everything that they do is always having support. Let them not do business because of relationship. For example, if I have a sister company between A Limited is my company, B Limited is also my company. So I decided that they are doing business with each other, but because I'm a common director, I don't see this need of them signing documents. This can actually give loan to B, B can give loan to this. Remember, I'm a director here and a director here, but there are some other directors I'm not allowed. Here are also other directors. But because I feel these are one thing, their sister company, there's no need of writing any document. What will happen? When B fails to pay, A will start complaining. But B will say that there is no evidence. You didn't give me any money. In fact, I didn't request. You see? So that is the time there will be financial loss because there was no proper documentation. There was nothing that is tying the two together. So that is why related party transaction is very important to avoid such kind of conflicts, in case of anything. The next one, most related party transactions, they happen at a rate or prices that are below the market price because they fear tax. So wanasema, instead of you selling to me this good at this price, I'm going to pay tax because of the high cost. We know how we trade. You just write anything, I'll pay you in your account, but on the agreement and in documentation, just put this amount. So you will realize that they don't do transactions at par. at the market rate. That one is also very dangerous because we will not be able to keep proper records with the supporting documents. Also, they are not going to be compliant in terms of tax payment. They are not going to pay tax because they can always talk and agree that we can hide this so that we are not exposed to tax. Those are the reasons why we need to understand related party transactions. Are we together? So in summary, number one, self-interest. Number two, risk in terms of disagreement. Number three, the nature of transactions. Sometimes they want to hide, they don't disclose, and again, they don't comply with some of the regulation requirements, Okay, so after looking at that particular area, we need to look at group accounts and joint audits. That is number 5. Group accounts and joint audits. Group audit, stop joint audit. Group audit or joint audit. Now, when we talk of group audit, we are talking about group audit in two ways. We can come and audit as a group, as a team. That is also called joint. We are two people auditing one client. But also, I can be one person auditing a group of company. Like for example, Cooperative Bank and Jamibora, they became group. When Jamibora changed the name to Kingdom Bank, they became a group. So when you are auditing group of a company. So you are auditing a group. Now, why is it important for us to understand groups accounts or a group audit? Let's look at how companies can become a group through merger and acquisition. That is true. You can buy, you can acquire, or you can come together, mergers and acquisition. But why is it necessary? Let's think about maybe Cooperative Bank. It took over a subsidiary that is called Kingdom Bank today. This particular subsidiary was having its own auditor. So let's think about audit of this company. The auditor probably defined network PKF. PKF was the auditor for the subsidiary. But the parent, the auditor was KPMG or PwC. These are very serious audit firms. Now, when this one take over, when Cooperative Bank take over Kingdom, they become a group. They have their own auditors. The person who will sign the books is the group of the auditor. KPMG will be the group auditor, will be signing a report for the whole group. So remember, they have not done audit for Kingdom, but they are going to sign report. Do you think it is going to be easy for them? That someone else does the work, PKF will do the work, then they come and sign. Can you tell me if it is possible? If it is not possible, why is it not possible? If it is easy, if it is not easy, why is it not easy for them to come and sign the report that has been done or audit that was done by a different audit firm? So this is the group audit. He is auditing for the group. He's going to sign for the group. So we have two areas where they didn't do the audit. Then there's also a possibility that they did audit. If they did audit, that is fine. If they didn't do audit, then there are things that we need to check. In exam, they will ask you, under this, why do you think the group auditor, that is the auditor for the group, the parent company, will not want to sign the reports for done by subsidiary auditor? Why are they not comfortable? The first reason is because they don't understand the scope. They don't understand the scope that was used by PKF, the group auditor, the subsidiary auditor. When the subsidiary auditor was doing this audit, there is a scope, extent where they covered. There is that limit where they reached. These guys don't understand because they didn't do that audit. Secondly, they don't understand the audit procedures. that these guys did. The audit procedures that were used here, they don't understand. That is why they are not comfortable. Number 3, the sampling technique. You know, when you're doing audit, you can't do every individual item in the population, in the whole ledger. You can't do every item, you can't audit. You'll always pick some sample. And so these guys are not comfortable signing a report that was done by a subsidiary auditor when they don't know the sampling technique. I hope we are together and you are writing some notes. The first one I talked about the scope. The second one I talked about the audit techniques or procedures that were used, audit procedures, then the sampling. Then the other one is the experience of the audit team, the experience of the guys who audited here. They don't know the experience. Then in audit, sometimes you'll make assumptions, like in case of materialities, you'll make assumptions. We are not very sure what you looked at or which kind of assumptions you were based on to come up with the kind of report that you're giving. You said that the report probably is a good report and qualified. What were the assumptions? Now, those are the things that we need to look at as we come here. That's why he's not very comfortable because of audit risk. He's going to actually expose himself by signing some books where he didn't even do the report. He's not comfortable with. Okay, so another question that you'll be asked here, you'll be asked, what are some of the factors that the group auditor needs to consider before relying on the work of subsidiary auditor? What are some of the factors that the group auditor, which is this one, needs to consider before relying and accepting the work that has been done by the subsidiary auditor? So probably they are the same things. Number 1, you need to understand the scope that was covered. You need to understand the sampling techniques, sampling procedures, or sampling techniques. You need to understand the audit procedures. You need to understand the qualification of the auditors. You need to understand the assumptions that were used. So they are the same thing. Those things that we considered as risk are now the factors that needs to be considered. That is about group audit. They will ask you now advantages of joint audit. Joint audit is where you're auditing the same firm. Like now, for example, KPMG might not be comfortable signing the report that has been done by PKF. So they can send their people. They can actually send a few people from here to join this team so that they do audit together. They do audit together so that at least they become comfortable because they were part, at least their team was part of the audit process. Yani, they bring their person or their people to be part of this team. So when they're doing audit, they're doing together. With that, they will be comfortable because at least they'll be able to understand what was being done. Now, in a situation where 2 audit firms are auditing one company, that is called joint audit. Now, in exam, they will ask you, what are some of the advantages of joint audit? Advantages of joint audit. So number 1, we know that, for example, if this team joins PKF, PKF has been here before, the subsidiary auditor, and they have been joined by another team. That other team is very blank. That new team who has joined is very blank. But the old ones at least have experience. They have background of the client's business. They have background. So what happens? They can easily explain the areas of high risk. They can be able to explain to them the experience that they have and even the nature of business. There are things that they will be able to tell these people. So because of the experience, they'll be able to make the work easier. They can save their work by telling them areas where they need to focus on, areas of high risk, the nature of business, and even the attitude of the management. A lot of things. They have experience. So they'll be able to share experience with the new team. That is the first point. They'll be able to share experience with each other. Number 2, in case of liability, in case of a situation where something wrong has happened and you are being told that now you have to be liable, you have to pay for some liabilities, the 2 firms will share the risk. So that is the second point, sharing of the risk. Are we together? Sharing of the risk. Okay, so those ones have not checked the notes, but I know those are areas that can be set. The last one here is analytical review. Analytical review is very important that you need to perform your analysis. You know, there is analysis that you do before you go to the field. That one will help you to go and focus on areas of most high risk. But after doing your work, you're back to the head office. You need to do analytical. Okay, sorry for that. So I was talking about the next thing here, analytical review. Topic we'll be able to look at analytical review. So basically, in analytical review, you are going to do analysis on the final figures that you have after audit. You remember, after audit, you'll be given final figures now. You've verified them, they are accurate, and you feel you can now present them. But when you're doing presentation, you have to first do analysis so that you can understand or bring meaning out of those figures. I know you've seen in the newspapers or even on your televisions when they are saying that Equity Bank has actually performed well this season. And the auditor is explaining that this one is due to uptake in mobile banking, meaning that the person who did an audit was able to do analytical review. He analyzed the reasons behind the figures, the reasons behind the increase in terms of the revenues. The revenues have gone up because of this. Expenses went down. This year they are focusing on this. This one is what we call analytical review after the audit, post-audit analytical review. And that one is done after the audit. So during evaluation and review, you need to understand the movement. So that, for example, in 2020, if, for example, 2020 report, 2019 report here, 2020 report, you can be able to see that probably we have revenue here. Here, 5 million. Here, it has gone up by 10 million. So review, when you're going to do analysis, you see that there was an increase by 5 million, and increase here is 5 million. That is 100% increase, any amount equivalent to the original. So you are going to explain that there was an 100% increase in terms of revenue. This one is due to an uptake in loans. And how did that happen? There are terms that are favorable conditions of giving loans. That is why there is an increase by 100% equivalent amount. So that is an analytical review. This one will help you explain after the audit the movements that have happened and the reasons behind them. Okay, so after that, I think that is the end. I will wish to stop from there because I wanted just to do some small class. I wanted to do free class for those who have never enjoyed my classes and tell them to feel most welcome. Our timetable is normally on Friday and Sunday. Saturday, I've decided to do this particular brief introduction of this topic so that tomorrow we'll go into it in details in our normal classes. Yes. So any comment or